7 business days. That is the distance between where you are sitting right now and the April 2026 COMEX first notice day. 1,727 contracts are still open. That is 9.6 million ounces of silver that somebody expects to collect in physical form from a vault system that just lost 2.03 million ounces in a single session on Friday. And while that clock ticks down, bombs are falling on Tehran, the Strait of Hormuz is contested for the 23rd consecutive day, and the Federal Reserve just told the entire precious metals market that relief is not coming anytime soon. Silver closed the week bleeding. The paper price touched $64.58 on Monday morning, according to FX Street. That is a 4.82% drop from Friday alone. But here's the part that should make every single person watching this video sit up a little straighter. The vaults are not refilling, they are accelerating in the opposite direction. Paper says sell. Physical says there is almost nothing left to buy. Both of those statements are true at the same time, and both of them cannot survive in the same market forever. One of them is lying. And in a moment, I'm going to show you exactly which one. With numbers, you can verify yourself before this video ends. This is OG John AG, and if you are new here and you want to understand what is actually happening beneath the price, not the ticker, not the headline, the actual molecular structure of the silver market, hit that subscribe button and stay close to this channel. What I am about to walk you through today is the kind of information that does not age well when ignored. Let me set the scene with what happened in the last 72 hours alone. On March 18th, the United States Federal Reserve held interest rates steady at 3.5 to 3.75%. That was expected. What was not expected was the signal that followed. One rate cut. That is all the Fed is projecting for the entirety of 2026. 1. The market had been pricing in at least 2. When that dot plot landed, every leveraged position in precious metals felt the ground shift. Silver was trading above $77 on March 18th. By March 19th, it had cratered to $66.93. That is a $10.84 single-day collapse. Think about that number for a second. A double-digit intraday wipeout on a metal that was trading above $120 just 8 weeks earlier. The February crash that everyone called a once-in-a-generation event, silver just rhymed with it again. And the catalyst this time was not a margin hike. It was a central banker standing at a podium and saying the word "one." But the Fed was only the first domino. March 20th brought a brief recovery to $72.10, up $5.17 in 24 hours. Then Monday arrived, March 23rd. And the Middle East delivered the second shockwave. The United States and Israel launched what Al Jazeera described as an unprecedented wide-scale wave of strikes across Tehran. Iranian air defenses activated over the eastern districts of the capital. The Strait of Hormuz, through which roughly 20% of global oil and gas passes, has been effectively contested since the war began 23 days ago. Shipping analysts at Zanetta publicly stated that transiting through Hormuz is completely off the charts for the rest of 2026 due to the security situation. Brent crude spiked 4% intraday before Trump announced a 5-day postponement of strikes on Iranian power plants, citing what he called productive conversations with Tehran. Oil then reversed violently, with Brent crashing 6.3% to $99.71 and WTI falling 7.37% to $90.99. Iran immediately denied that any talks had taken place, and right in the middle of this geopolitical whiplash, silver was caught in the crossfire. So where does the price actually sit right now? Fortune pegged silver at $69.39 at 8:45 a.m. Eastern on March 23rd. FX Street recorded $64.58. CBS reported $68.49. The discrepancy itself tells you something. When 3 major financial outlets cannot agree on a spot price within a $5 range during the same trading session, you are not looking at a normal market. You are looking at a market that is fracturing in real time between the paper side and the physical side, and the fractures are widening with every session. Now let me take you underneath the price, because this is where the story changes completely. The COMEX registered silver inventory, that is the metal actually available for delivery against futures contracts. The only silver that matters when someone says, "I want my bars," stands at 78.95 million ounces as of March 12, 2026. Read that number again, 78.95 million. In April 2020, that figure was above 300 million ounces. That is a 67% decline, not over a decade, over less than 6 years. And the bleeding has not slowed, it has accelerated. The drainage rate is currently running at 22 to 23 million ounces per month. On Friday, March 20th alone, the vaults physically added only 41,000 ounces, while 2.03 million ounces walked out the door. That is a net outflow of nearly 2 million ounces in a single day. At this pace, The COMEX Stress Index, a composite score combining coverage ratio, inventory trend, paper leverage, and vault outflows, sits at 84 out of 100, near its all-time high. The coverage ratio has collapsed to 13.7%. For context, anything below 15% is considered stress territory. The paper leverage is running at 7.3 times the deliverable metal. That means for every ounce of silver that can actually be handed over to a contract holder, there are 7.3 ounces worth of promises floating in the system. Hold that thought, because here is the part that makes the math terrifying. March 2026 opened with 10,526 contracts standing for delivery. That translates to 52.63 million ounces of silver that buyers demanded in physical form against a registered inventory of 86.13 million ounces at the time. That is a 61% claim rate against deliverable stock in a single month. And this came immediately after February 2026 delivered 5,036 contracts, 25.18 million ounces, making it the highest February delivery volume in modern COMEX history. January before that, 49.4 million ounces, 7 times the January 2024 figure. All of 2025 combined settled 474 million ounces of physical silver against 203 million the year before. The delivery volume more than doubled in a single calendar year, and now April is loading up. 9.9 million ounces in potential April delivery demand are already building, representing 12.6% of registered inventory before first notice day even arrives, 7 business days away. So if the vaults are hemorrhaging metal at a pace never seen in exchange history, and delivery demand is running at multiples of prior years, and paper leverage is stretched to 7.3 times physical supply, why is the paper price crashing? Pull up CME open interest right now while this video is playing. Look at the managed money positioning. In February 2025, managed money held 54,415 contracts. By February 2026, that number had collapsed to 12,121 contracts. That is a 77.72% year-over-year wipeout of speculative positioning. The hedge funds ran, the leveraged longs got flushed, and every single margin hike, every hawkish Fed signal, every headline about Iran or recession fear gave them another reason to liquidate. But here is the critical distinction that most people watching price charts completely miss. The people who left are paper traders. They never intended to take delivery. They were betting on price movement. The people who stayed, you're the industrials, the institutions, the sovereign accumulators. They are not watching the ticker. They are watching the vault. And the vault says 78.95 million ounces, draining at 22 million a month, with April demand already stacking. Let me bring in the China dimension because it compounds everything I just described in a way that most Western analysts still have not fully absorbed. On January 1st, 2026, China implemented export licensing controls on silver that the state-run Securities Times described as elevating the metal from an ordinary commodity to a strategic material on the same regulatory footing as rare earths. Only 44 companies received authorization to export silver for 2026 and 2027. The production threshold is 80 tons annually, effectively concentrating export authority among the largest state-aligned producers. Industry estimates suggest this framework could restrict 60 to 70% of the global refined silver supply to domestic Chinese use. The impact has been immediate. Shanghai silver inventory collapsed from 559 tons in November 2025 to 318.5 tons by February 2026. That is a 43% decline in 4 months. Shanghai premiums over Western spot prices have persisted in the range of $5 to $10 per ounce, and at various points during the January spike, physical silver in parts of Asia traded at premiums exceeding 50% over COMEX quotes. China exported over 4,000 tons of refined silver in the first 11 months of 2025. Then the door shut, the era of cheap Chinese silver flowing west to plug deficits is over. And the deficit itself? The Silver Institute projects the 6th consecutive structural shortfall in 2026, estimated at 67 million ounces. 6 years running. Not a blip. A pattern. Now here's the part where the conspiracy community and the data community briefly occupy the same room. And I want to handle this with the seriousness it deserves. In late January 2026, silver spiked to approximately $117 to $120 per ounce on a Thursday. By Friday, it had collapsed to roughly $78, a 35% intraday wipeout, the worst single day for silver since 1980. On that same Friday, CME hiked margin requirements as liquidity thinned into the weekend. The London Metal Exchange reportedly experienced disruptions, and JP Morgan, the same institution that paid a record $920 million fine to the CFTC in 2020 for spoofing precious metals futures over an 8-year period from 2008 to 2016, allegedly closed a large silver short position at or near the intraday low. Social media exploded. The word engineered trended. The word flush appeared in every other post. And the question that has haunted the silver market for 15 years surfaced again. Is the paper price being actively managed? Let me give you the honest answer. The fine was real. The conviction of JP Morgan traders was real. Hundreds of thousands of spoof orders were documented by the Department of Justice. That is not conspiracy, that is court record, but the claim that JP Morgan is currently in distress from silver shorts, the data does not support it. JP Morgan's stock traded near 52-week highs in January 2026, trailing 12-month net income exceeded $56 billion. Total assets exceed $4 trillion. Multiple analyses suggest the bank has actually flipped to a net long position and is profiting from the rally rather than being crushed by it. Viral posts alleging that Bank of America is short 1 billion ounces and Citigroup is short 3.4 billion ounces have garnered millions of views. But no regulatory filing, no CFTC enforcement action, and no public disclosure has confirmed those figures as unhedged positions, creating existential risk. The Fed's year-end repo spike of approximately $74 billion that some attributed to a silver-related bailout appears consistent with routine year-end window dressing, not emergency intervention. The banks are not collapsing from silver. Not yet. And I say not yet, deliberately, because there is a difference between a position that is manageable at $70 and a position that becomes unmanageable at $150. And nobody outside those trading desks knows where that line actually is. And if you think the COMEX picture is alarming, London is telling the same story in a different accent. The LBMA reported that London vaults held 27,065 tons of silver at the end of February 2026. That is down 2.4% from the prior month, but the headline number disguises the real problem. A significant portion of that metal is locked inside ETF allocations and private client holdings, silver that technically sits in London but is not available to the trading market. The free float, the actual liquid silver that can be lent, sold, or delivered against contracts, has been hovering around 140 million ounces since late spring 2025, according to analyst David Jensen. And it has not budged despite silver's price more than doubling in that period. Meanwhile, the one-year implied silver lease rate in London has surged above 5%. When it costs that much just to borrow silver temporarily, the market is screaming that holders of metal refuse to let go of it. On October 10, 2025, the London silver market literally froze for 90 minutes because there was not enough liquid silver to complete trades. Not a flash crash, not a technical glitch, a physical absence of metal in a market that trades roughly 600 million ounces of silver per day on paper. The LBMA's own data suggest promissory note claims in London sit somewhere between 1 billion and 2 billion ounces against a free float that appears functionally near zero. That gap between promise and metal is the single most dangerous fracture in the global silver market right now, and almost nobody in mainstream financial media is talking about it. That brings me to the bearish case, and I am not going to insult your intelligence by pretending it does not exist. Silver has fallen from $120 to $64 in less than 8 weeks. The Fed just signaled higher for longer. The dollar index is posting multi-month highs. Bond yields are climbing. CoinCodex's algorithmic model projects silver at $59.37 by March 28th and $53.13 by year-end. Marko Kolanovic, the former chief strategist at JP Morgan, has publicly called for silver to trade at roughly half its January highs. His argument is grounded in history. The 1970s saw gold surge from 40 to 200 before crashing 50% and shaking out every weak hand before the final run to 800. Silver's volatility is structurally higher than gold's. Its industrial exposure means it reacts to recession fears in ways gold does not. And the Iran war, while bullish for safe havens in theory, is creating the kind of liquidity crunch where even gold gets sold to cover margin calls in other asset classes. The oil shock is raising stagflation risk, and in a stagflationary environment, the Fed's hands are tied. They cannot cut rates to support metals without fueling the inflation that is already running hot from energy prices. That is a genuine trap. And it is the single strongest argument the bears have right now. But the bears have to answer one question that none of them have addressed satisfactorily. Where is the silver coming from? Not paper silver, physical silver, the metal that goes into solar panels consuming record volumes every year, the metal that goes into every electric vehicle rolling off every assembly line in Asia, Europe, and North America. the metal that AI data centers require in quantities that did not exist in any demand model 3 years ago. Mine production peaked around 2016. Roughly 70% of silver is mined as a byproduct of base metals, meaning higher prices alone cannot rapidly increase output. China just locked the door on 60 to 70% of refined global supply. COMEX registered inventory is at 78.95 million ounces and falling at 22 million per month. London vaults held 27,065 tons of silver at the end of February, down 2.4% from the prior month, and the free float, the silver actually available to market as opposed to privately held or committed to ETFs, appears near zero based on the persistence of 5% plus lease rates. The London market seized up for 90 minutes on October 10, 2025, due to lack of available liquidity, despite hundreds of millions of ounces technically sitting in the vaults. Technically sitting there, functionally spoken for. Lower prices do not reduce industrial delivery demand. Production schedules, contractual obligations, and end-use requirements do not change because the ticker moved from 83 to 64. A solar panel manufacturer in Anhui province does not cancel an order because a hedge fund in Connecticut got margin called. The investment channel contracts on hawkish signals. The physical channel does not blink, and right now the investment channel is being purged while the physical channel keeps pulling metal out of vaults that have less and less to give. In January 2026, Turkey imported a record 273 tons of silver in a single month. The Sprott Physical Silver Trust doubled its capital raise program to $2 billion, enough to absorb approximately 18 million ounces, roughly 23% of current COMEX registered inventory, in one institutional move. JP Morgan shipped metal eastward at premiums of $10 per ounce or more, with Asian buyers absorbing both the premium and the fiat. That is not speculation. That is procurement under duress. The paper price is telling you one story, the vault is telling you a completely different story, and that divergence has a name in market mechanics. It is called a two-tier market. When COMEX quoted silver at approximately $71.50 in early January, physical bullion in parts of Tokyo and Dubai was reportedly changing hands at premiums exceeding 80%. Some transactions in the UAE cleared at $130 per ounce. Now, some of those figures included retail markups, local taxes, and scarcity premiums that inflated the headline. A fact check of Tanaka, one of Japan's largest bullion retailers, showed a more realistic retail price around $83 per ounce tax included at the time, not $130. But even at 83, that is a persistent 15 to 20% premium over Western paper, and that premium has not disappeared. It has become structural. Shanghai closed late December trading at $78 to $80 equivalents against Western benchmarks in the low 70s. That $5 to $8 spread should have been arbitraged away instantly under normal conditions. It was not, because the metal needed to close that gap cannot easily move. China has locked its supply behind an export licensing wall. London's float is functionally committed. COMEX is draining. The arbitrage mechanism that is supposed to keep global prices aligned has broken because the physical silver required to execute it does not exist in sufficient quantity where it needs to be. And 7 business days from now, when April 1st notice day arrives and those 9.9 million ounces of standing demand meet a registered pile that may have shrunk below 75 million by then, the market will have to reconcile those two stories, whether it wants to or not. Here is what I think happens next, and I want to be precise about this because I am not in the business of hype. I am in the business of following data to its logical conclusion. If the Iran situation escalates further, and Iran has already denied that any talks occurred, directly contradicting Trump's claim of productive conversations, the Strait of Hormuz disruption extends, energy prices remain elevated, and the stagflation narrative hardens. In that environment, the Fed cannot cut, the dollar stays strong, and paper silver remains under pressure from the investment side. But the physical side does not care about any of that. Industrial demand is inelastic. Vault drainage continues. And every dollar the paper price drops, opportunistic sovereign buyers and institutions accumulate more metal at a discount, just as Turkey did in January. The floor is not set by the ticker. The floor is set by the vault. And that vault is running out of floor. So here's my question for you, and I want you to genuinely sit with this one. If the paper market can push silver to $64 while physical delivery demand is running at record pace, and registered inventory is at a 67% discount to its 2020 peak, what happens to the paper market's credibility the first time a major contract month cannot deliver, not hypothetically, not in a thought experiment, structurally? What happens to the pricing mechanism that the entire Western financial system relies on for this metal? Because that is not a question about silver anymore. That is a question about the architecture of trust. If this breakdown made you think, And I mean actually think, not just nod along. Share this video with one person who still believes the ticker tells the whole story. Hit that like button because the algorithm buries content like this unless you tell it not to. And if you watch this all the way through, drop a comment that says exactly OG John AG 2.0. I read every single one, and it tells me who in this community is paying real attention versus who is just passing through. This is OG John AG. Logic over noise. Data over drama. The metal is real. Make sure your position is too. Stack with your eyes open.